Hi guys, and welcome back to Ask Rhyce, where I answer your questions about real estate. Today's question was just around some real estate jargon. I've had a few questions over the years just about like what different, common in terms of our industry, what they mean. Today I just wanted to go through. So today I've got 11 common, common terms or jargon, real estate jargon, that you probably, if you don't know it, you should, and could help you out in the future. So the first one for me on my list is bridging finance. Now, what is bridging finance? Bridging finance is when you're purchasing a property and you need to sell your current property, or your current property is on the market. But you need the finance from that property eventually to secure your new loan. Bridging finance is a product from banks or lending institutions which helps you literally bridge the gap between those loans. It does come at a little bit of a premium. It's not too bad. We have a number of people over the years who use it and have taken advantage of it in order to get their purchase to go ahead. But think of it this way: bridging finance, it helps you bridge the gap between the funds coming from a property that you own, that you're either selling or you will sell in the very near future, to then help you with the purchase of your new property. So bridging finance, think of it as it's another tool in the lending toolbox, and something that some people take advantage of it, some people don't. There's a little bit of a premium to use it, but can be a fantastic tool if it's something that you need. So that's the first one. Second one on my list is CGT. Most people don't know what CGT is unless you've sold a property, or if you haven't sold a property, you may not know what it is. CGT is just capital gains tax. So if you're selling a property and it's not your principal place of residence, so principal place of residence is where you live, so it's an investment property, then you may be up for capital gains tax if you've made money on the sale. So if you purchased the property for X amount and you sold it for X, so the same value, then you're not going to have capital gains there. But if you've made a capital gain on the property, so you've sold it for 10, 15, 20, 100,000, $200,000 more, then that's your capital gain, and you may be liable for tax. So CGT, capital gains tax. The next one, now the next two are on just our standard contracts. Now, sometimes they're filled out in more detail. It really depends on the property and the contract itself. But the first one is fittings. So fittings, and the second one will be fixtures, but I'll talk about each individually. So fittings and fixtures, what are they? Fittings on a house is something that can be taken from a property without causing any damage to the property. So a good example of a fitting could be like a washing machine or a fridge or a dishwasher is probably the most common one that we do see put into a contract. Because a dishwasher, even though it might form part of a kitchen, look very neat and tidy, at the end of the day, a dishwasher only needs a power point and a tap connection for it to be removed. So it's really important that that portion of the contract, so there'll be a section for fittings and there'll be a section for fixtures, it needs to be completed as to whether or not there are items that are to stay or not stay, or fittings that are to stay or not stay. Fixtures is something that's actually fixed to the property. So a fixture could be the carpets of a property. It could be the kitchen cabinetry, as an extreme example. Not that we would normally see that listed there, but I guess a fixture, if it was something that it could be the possibility that it would be removed, or the owner might want to remove it. As a seller, then the buyer they'd want to make sure that anything that they could be worried about there would go. Just back to the fittings, another great example in terms of fittings. It's not something that would necessarily stay, but when we sell acreage properties, quite often people will include ride-on lawnmowers, for example. If they're downsizing, they don't need a ride-on lawnmower. That could be a fitting that goes with the property. Right, so that's fitting and fixtures. The next one on my list is LMI. Now, LMI stands for Lender's Mortgage Insurance. Now, last week we talked about LMI not last week, a couple of weeks ago, with Charlie from Bank of Queensland. And for first home buyers, the LMI is very important because the new election promises from the Morrison government to help first home buyers is around Lender's Mortgage Insurance, and that they will guarantee so that there isn't the need for Lender's Mortgage Insurance. But Lender's Mortgage Insurance, typically, as Charlie was talking about last week, if the loan, if someone needs to borrow more than 80% of the loan, then in most cases Lender's Mortgage Insurance would be needed. And all that does is that ensures the lender, it protects the lender in case the borrower defaults on the loan. So they're not able to go and complete the loan and they default on that contract. So Lender's Mortgage Insurance, LMI, if you ever see that. The next one, obviously relative, and Lender's Mortgage, we just talked about, a more than 80% loan. When we're talking about percentages, quite often you'll see the term LVR. LVR is loan to value ratio. Now, the loan to value ratio is how much of the property's value, or how much do you need to actually borrow. So if a property's worth $200,000, you need a $100,000, or you've got $100,000, but you need $100,000 to purchase the property, then you're looking at a 50% LVR. So the actual value of the property, you're looking at, you're only having to borrow 50%. So LVR, loan to value ratio. The next one is settlement date. Now, again, it's a term that we use every day in the industry, but a lot of people may not know what it is. Settlement date is the day that keys are exchanged, money is exchanged for a property. So that's the final step in the sale or buying, life cycle, or period of a sale, is when keys are exchanged and money's exchanged. So from an agency point of view, once we get confirmation from both parties that settlement has taken place. Now, settlement is the exchange of checks, literally. So whatever the final settlement amounts are, they exchange checks. Once we know that that's happened, then we can release keys. So settlement date, that's what settlement is. It's the completion of the sale. The next one, back up to a lending point of view, is a term that some people may have heard of, but some haven't, is a guarantor. A guarantor on a loan basically is someone that is guaranteeing that if the main person for that loan had to default and wasn't able to complete that loan contract, that the guarantor would then take over and they would complete the contract. So a guarantor, sometimes people need guarantors to get their finance over the line. It's not something we see used all the time, but it is, again, something that does come up. If you need a guarantor, it could be another way for you to be able to get your finance to go through. Appreciation. Appreciation is literally just the increase in value over time. So what we commonly talk about is that just take a run-of-the-mill house. The house itself, so the physical structure, depreciates, which is the next term I'll talk about, but the land value appreciates over time. So for me, appreciation, that's just the increase in value over time. Depreciation, which as I said is the next one, is a decrease in value over time. But the key distinction that we normally make is that the land value is slowly increasing. The property will see a decrease in value. So as the actual structure gets older, it's not worth as much as what it was if it was brand new. So we normally see that come down. However, when we see substantial growth, that key thing is that it's really that land value, the desirability of that area that's pushing as well. And I mean, obviously you can increase a property's value, you might do renovations, etc., which will help it appreciate in value. But as a general rule, if you're not doing anything, you'll see the structure and the property over time depreciate. So appreciation and depreciation. Appreciation is the increase in value. Depreciation is the decrease or reduction in value over time. The final one I'll talk about, so we've spoken about LVRs and lender's mortgage insurance. Another common term that comes up that not a lot of people, especially if you haven't owned a home before, is equity. Now, a lot of people talk about being able to use equity, etc. And what is equity? Equity is just how much of the property, of a given property, do you own. So if you have, for example, a house that's $400,000, but you have a loan for $300,000, that means that the equity in that property would be $100,000. So overall value, $400,000. The loan amount, $300,000. You would own $100,000 of it. So that's equity. So over time, for your principal place of residence, where you live, obviously we want to keep chipping that down and make sure your equity's going up. But yeah, equity, that can be great, and you can use equity into your next property. So we started this off with bridging finance, people using money. They're talking about using the money that's already existing in a property. So the equity that they might have in one property, based on what they've got there, the new loan they've got, that's where people can use that. So when you're talking about once you've starting to own properties, that equity can form part of, or it does become, your deposit on your next property as well. So, guys, that's 11 different common terms or real estate jargon. Some of them, look, you may have known some of them. If you didn't know some of them, I really hope that helps. If you have any other questions, no matter what it is regarding real estate, feel free to post them in the comments below, and I will talk to you again soon. Thanks.